welcome to the third edition of our pre-budget series, Ideas for India. We discussed the first two pillars, fiscal balance and then efforts to revitalize the banking sector. The third pillar on which the budget may rest is its push for infrastructure. Starting from the BJP manifesto to the accent of the Modi government, it has always been on infrastructure, be it smart cities, the gift city, freight corridor or bullet trains. The FY16 budget had increased allocations to roads and railways to 40,000 crore rupees each and had also mooted the NIIF, the National Infrastructure Investment Fund. To be fair, the National Highway Authority has bid out 69% more projects in FY16 compared to last year, spent 60% more money and will ensure completion of at least 20% more road kilometers at 1,800 kilometers this year. So what can one expect from the budget this year? More fiscal slippage and therefore more expenditure on infrastructure? Out-of-the-box ideas for fundraising for infrastructure? Any improvement in the legal backdrop for the public-private partnership structure? Well, these are some key ideas which India Inc. has been speaking about. But to get more details on these and more ideas and expectations from the budget, I have with me a star panel, three stalwarts from the infrastructure space. Mr. R Shankar Raman, Director of Finance at L&T, Anil Sardana, Managing Director, Tata Power, and Mr. Unnikrishnan, the CEO and Managing Director of Thermax India. Gentlemen, welcome. Thank you very much for joining me. Well, Mr. Shankar Raman, let me start with you. What's the big expectation you have from the budget? We know finances are a problem. Last year, if I counted the capex, both plan and non-plan, it came to about 2.6 lakh crore thereabouts. In any case, it is less than 2% of the total budget. Is this enough to give any push at all? 2% of the GDP?
No, I think India is in a very interesting space now. It's very important that we find space within the budgetary framework to push investment. I think India is a large market waiting to consume, completely underserviced, is all well-known fact and documented. What is the missing piece is the ability to infuse capital in the most productive manner possible. According to me, I think very clearly, this 1 lakh crore or 1.2 lakh crore spread over 3 or 4 sectors is highly inadequate. And if I were to look for what the budget can do for the country, and leave aside the interests of the corporates which could benefit alongside, what India needs badly is confidence in its ability to invest right and the sustainability of that investment over a period of time. We're talking about possibly $100 billion gap every year. And if you talk about a 5-year period, we're really talking about $500 billion. We have to make a start somewhere. And I think the best place to start would be an indication in the budget where the government takes some bold steps, just double the kind of investments that they can have and have a mechanism to lever the investment so that you have a multiplier effect coming through.
Okay, no, that point is well taken, double the investment in infrastructure. But where from, Mr. Shankar Raman? You know, the crude advantage is there, but it was there this year as well, and we still didn't find too much of money for investment. It's not as if tax revenues will go through the roof. And then you have the Senate Commission obligations as well. You know, the ability to err on the fiscal profligacy side is simply not given by the bond markets. Bond markets are at 7.95 in a year when you are sticking to the fiscal discipline. If you were to err on the side of profligacy, bond markets will go to 8% plus. So where will the money come from?
Actually, you'll have to create it out of the asset side of the balance sheet than the liability side of the balance sheet. If you look at the country, if you take all the PSUs, in my assessment, they have close to 90,000 crore to a lakh of crore as cash equivalents. I think it's very important. At least a third of that needs to be spent on capacity enhancements of the kind that will trigger infrastructure investment. Secondly, we have, fortunately, oil likely to stay soft for some time, and that has a potential to generate about 30 to 40,000 crores. The third important piece is we have been planning about divestment in a broader sense, not only equity, even assets. Now, should the government own as much of physical and financial assets that they own today to generate an ROE which is substandard? So even if you go and let the government play investor to see which are ROE accretive, which are not ROE accretive, some amount of lightening the balance sheet would be necessary. It is important to monetize these assets to generate another 30,000-40,000 crores. Even if you put these three pieces together, we are talking about an additional 1 lakh crore. And if you are able to get this in a form, and National Investment in Infrastructure Fund was one such, you could lever maybe once, twice, 2 times the investment. Even if I am conservative and say that another 1 lakh crore gets levered, we are talking about 2 lakh crore on top of 1 lakh crore, which is residing in the balance sheet. Now, for a start, this might be inadequate, but for a start, it makes a bold statement that the government is willing to focus on a point in the asset side and then drive it.
Yeah, okay, point taken. Existing infrastructure assets of the government could definitely be securitized, be it ports, be it roads, point taken. Time permitting, I'll come back to the tax incentives that may be granted. But let me come to another prickly area which the Kelkar committee addressed and which Mr. Sardana will perhaps be personally able to speak about. The private-public partnership, Mr. Sardana. What, all said and done, this 2 lakh crore can become 3 lakh crore from the government. That is still 2% or 2.5% of the GDP. Ultimately the private sector will have to be drawn. Do you think that the budget could concentrate on this PPP regime and improve it in some substantial way?
Yes, Latha, that's a very significant factor which is what we are all waiting for. Fortunately, the recommendation of Kelkar committee is there with the government now, and one is hoping that in this budget they will have the announcement of acceptance of that committee recommendations. It's important that we have more and more of PPP projects, but as RSR rightly mentioned, if one was to build a confidence that the PPP projects would be taken up now, it is important that the past PPP projects, which are kind of stranded, and a lot of equity as well as the debt portion is unproductive, is made productive very quickly. So if you take power sector as an example, but I think similar is the case with many other sectors, which is there in the PPP committee report. There has to be a concerted effort of the government to make sure that project by project resolutions are immediately put in place and those equities and debts are made productive. And once you do that, then you see that the power sector will be bullish to participate in the future investments, as also the banks will then have better situation to fund new projects. So it is an all-round important aspect that the recommendation of Kelkar committee are adapted and implemented in the current year.
Yeah, actually in roads they did that. You could bring your equity in a deferred fashion. Some of the roadblocks were removed for the existing stock. Is there anything specific, one or two things that you might say in the power sector that might de-bottleneck the stock of stuck projects, Mr. Sardana?
In fact, Latha, you have to do exactly what the road sector saw the ministry doing, where there wasn't sort of a one solution fits all was adapted. They very clearly sat with individual road projects and saw what was ailing that project and why was it not moving.
That's right.
What will it take to correct that? And as you said, in some cases the original promoter was replaced, the equity was taken over at 1 rupee and the new promoters were brought in. In many cases, NHAI came in and pulled in with the incremental requirement, and the objective being that the projects are now well on its way and the projects were debottlenecked. In power sector also, it's important to pick up each project. In some cases, it will be the fuel allocation that has to be done. In some cases, it is the issue of PPA that needs to be resolved. Project by project, one has to see, and that's exactly the recommendation. If you go through the Kelkar committee recommendation, it states so that there should be a forum wherein respective each individual project problems or issues need to be dealt with and resolved, because it is unlikely that over a period of 25 years somebody will be able to hold all that was there at the original point of bidding or original point of allocation to remain same.
I think I've been asking two pointed and straight-jacketed questions. Let me give a blank check question to Mr. Unnikrishnan. What would be your top expectation or even urge, request to the Finance Minister?
Number one is more as an Indian than as a CEO of a company. First of all, be prudent in fiscal level, because no freebies. I would believe that the government has got to be really announcing mega projects like the way Mr. Shankar Raman mentioned about. Not to be shy about upping the size of projects, $100 billion worth of projects in the infra sector, which would certainly ensure that even the private sector will want to participate and also will take cue from and will announce their own projects. That's the point number one. Government has got to be very bold enough in announcing and following through the projects.
Okay.
Just take last year in the budget, the finance minister mentioned about 4 UMPPs to be brought in, but nothing has happened so far on that. So let him not make any announcements which are going to be remaining on paper. What can be executed is what we are expecting.
Yeah.
Other worry we have, Latha, is about even if one were to be announcing projects, whether the private or public sector, only 20 to 25% will come as equity from the investor.
Yeah.
75 to 80% has got to come from the bankers. So do they have money to be bringing in along with the investor? That's the biggest worry. So bank recapitalization or whatever needs to be done to ensure that banks do have enough of money available with them to invest along with the investors in the coming year will be another requirement that we look forward to.
We have to take a quick break, but thereafter lots more questions to our star panel on what can be done for infrastructure by the budget. Back in a minute.